It's Friday, May the 20th. And we sent an email out to all of our clients this past week. Why don't we talk a little bit about the gist of that email?
Well, the first thing we wanted to do is to relieve a little pressure, assure you that we're cognitive of everything that is going on and how it's influencing you and concerning you. And we wanted you to know we have definite plans and are meeting with folks to help firm up decisions we're making about how to manage through this.
And one of the things we're going to do, and without getting into too much detail, is that we are sitting on a lot of cash, and that cash is not generating much of a return at all. It's not losing, but it's not generating a very positive return. So we're going to be looking at buying individual bonds that have maturity dates between 1 and 2 years. In fact, we'll probably ladder two. One would mature in 2023, and one would probably mature in 2024. And we're going to get a rate of return that would be substantially higher than what we're getting in just pure cash right now.
And then we're going to leave the cash because an interesting phenomena occurred in the stock market this week. We talk oftentimes about PE ratios with stocks. That is, what's the price to its earnings? Is it a fair price? And typically when you see it in the $10 to $15 range, it's thought to be a fair price for a stock. This week, tech stocks are virtually at the same PE ratio as consumer staple stocks. Now, consumer staple stocks pay a dividends. Tech stocks do not pay dividends typically for the most part. You think of tech stocks as the growth, the front end of the train pulling it, and you think the dividends are really what's in the middle of the train going down the tracks. But for the first time, we might have a good buying opportunity looking out into the future of buying into some tech stocks. So we're going to hold, or not specifically tech stocks, stocks in general. So we're going to be holding onto some cash, looking for opportunities for high quality companies, good cash flow companies, companies that could pay dividends, or companies that could give us a growth opportunity.
And we're not market timers, but we're about to enter the summer months, and historically the summer months are not great for the markets. So we're not in a really good market right now, and then we're entering into a season that's not necessarily been a good season. So we probably will wait until as we head towards the fall, and then of course we have the midterms coming, and we do think that the midterms, especially if there's going to be substantial changes in the Congress, then we would like to take advantage of that. So the timing on the purchasing probably will be later than sooner.
The reviews in which we're doing is looking at your holdings, looking at holdings that are underperforming, looking at holdings that have opportunity of doing well, and rebalancing those holdings if it is appropriate. Looking first and foremost towards dividends and dividend paying positions. And then, as Gib has said, that led us off, we're going to shore up a piece of that cash and get a fixed period for a ladder that will mature into next year that will give us, again, other opportunities. Overall, the market, the stock market, the Dow, the S&P are down double-digit returns. We still are doing better than where the stock market is in terms of being.
And we should be, because we're not taking near the risk of the main indices.
We're pleased with that. We know it's trying. We know it's challenging. We're here to have a conversation with you. We're working as hard as we can on your behalf. We know it is your money.
And your money matters.
We're here. Call us. Have a good evening.